Every year, UK-based investors get to benefit from a capital gains tax allowance. This means you don't have to pay any capital gains tax on profits you've made from disposal of assets up to a certain limit. For this current tax year, this limit is set to £12,300. But from April 2023, this limit is being cut to £6,000, and the following April it will be cut to £3,000. Any unused CGT allowance cannot be carried forward from previous tax years. So why is this important? Well, if you hold stocks and shares outside of an ISA, they're liable for CGT at the point they are sold if you've made profit. If you think about how we use stocks and shares, you'll see where the problem lies. Most of us buy stocks and shares in the hope that they grow over a long period of time. This can be many years, and over all them years you could be building up capital gains that aren't realised, or profits that you haven't yet cashed in on. Meaning when you finally come to sell or to realise your profits, you're going to be hit with a massive CGT bill eating into your hard-earned cash. And this is only going to get worse for people. For a lot of people, this has never been an issue. £12,300 is a lot of money, but now that's being reduced, it's going to start catching a lot more people out. One way of getting around this is to realise or sell your assets just before the financial year end. That way you can utilise your CGT allowance for that year, as long as you have some left, of course. You can then rebuy your assets, or maybe you want to change to a different variety of assets in the new financial year, and your capital gains clock, so your base point, it resets. So if you put in £1,000, it doubled and it was £2,000, rather than £1,000 profit, you've just sold it, you've put it under capital gains, you've used your allowance, and now you start the next year with £2,000. Anything you make by the end of that financial year is then the profit or the loss, depending how you get on. This way you effectively break up your capital gains into small amounts every year, rather than one big amount at the end of your investing period, allowing you to use your CGT allowance effectively. However, the government soon clocked on to the fact that people were selling their assets and buying the same ones straight away again to utilise their allowance. So what they've done is brought up the bed and breakfast rule, meaning you can't immediately purchase the same assets straight away once you've sold them. If you do, they will still be liable for CGT at the end of the period, because that period of investment will be seen as one period total. Us investors instead have to wait 30 days before buying the same asset again, so it would not be treated as one investment period, it will be treated as two, and we can then utilise our allowance. There are some exceptions to this where you're able to sell it straight away and buy it back again straight away. And the first one is the bed and ISA. So basically you sell your assets and you move your funds into an ISA, and you can buy the assets straight away again without having the 30-day rule apply. Obviously once it's in the ISA, capital gains tax doesn't apply from that point on. You can also do the same with a SIP, but bear in mind that once your money is moved into the SIP, you have to wait for SIP retirement age before you can access that money again. And finally, you have bed and spouse. And this is where you sell your assets, you can gift the proceeds of your assets to your spouse, and a transfer in this way is not deemed to fall under the capital gains rules because it's shared between your spouse. Your spouse can then go and buy the exact same investments again, except they won't be in your name, they'll be in their name. These three methods mean you're not leaving a 30-day period where you're not invested in the funds or the investments you want to be invested in long term, potentially missing out on any gains in that 30-day period. Now it's worth saying, if you can invest in an ISA, you should. I know a lot of people don't or can't because they've used it all with cash and they're waiting to buy something else, or they have funds that can't be bought inside of an ISA currently. So in that case, carry on doing what you're doing and use this method to your advantage. You obviously need to have some or all of your CGT allowance in order to do this. Anything above will not count. You need to record everything you do, the amounts and what you've sold, for tax and tax return purposes. Thanks for watching. I'll see you in the next one.